Did you know margin trading can turn a 10% stock move into a 20% gain or loss? That's right, folks. Margin trading is like adding jet fuel to your portfolio. It can supercharge your gains, but buckle up because it can also magnify your losses. We're talking about a high-risk, high-reward game here, people. It's not for the faint of heart or the thin of wallet, but for those with the stomach for it. Margin trading can be a powerful tool to amplify your returns. Are you ready to learn more? Let's dive in. So, what exactly is margin trading? In a nutshell, it's borrowing money from your broker to buy more stocks or other assets than you could with just your own cash. Think of it like this. You put down a chunk of your own money and your broker lends you the rest, like a financial tag team. This borrowed money, my friends, is called margin. It lets you leverage your trades, meaning you control a larger position than your own money allows. More leverage means the potential for bigger gains, but remember, bigger losses too. It's like using a megaphone for your investments. The gains and losses are amplified. Exciting, right? But hold your horses, because we need to talk about the risks involved. Now, before you rush off to mortgage your house or take out a second loan and max out your credit cards, let's talk about the potential downsides of margin trading. It's easy to get caught up in the excitement of leveraging your investments, but it's crucial to understand the risks involved, because believe me, there are downsides. Margin trading can amplify your gains, but it can also amplify your losses. This means that while you have the potential to make more money, you also have the potential to lose more money. The biggest risk is the potential for amplified losses. When you trade on margin, you're essentially borrowing money to invest. If the market moves against you, you could end up owing more than you initially invested. Remember that jet fuel analogy? Well, if the market goes against you, it's like your rocket is headed straight for the ground. The speed at which your losses can accumulate is staggering. And trust me, those losses can add up faster than you can say margin call. A margin call is a demand from your broker to deposit more money or securities to cover potential losses. A margin call is like a financial alarm bell ringing. It happens when your account value dips below a certain level, and your broker demands you deposit more money or securities to cover potential losses. If you can't meet the margin call, your broker can sell your assets, even at a loss, to cover their own behinds. It happens when your account value dips below a certain level, and your broker demands you deposit more money or securities to cover potential losses. If you can't meet the margin call, your broker can sell your assets even at a loss to cover their own behinds. This can lead to a downward spiral where you lose more money than you can afford. If you can't meet the margin call, your broker can sell your assets even at a loss to cover their own behinds. This can lead to a downward spiral where you lose more money than you can afford. It's a harsh reality that many new investors don't fully grasp until it's too late. So, while margin trading can be tempting, it's crucial to understand and manage the risks involved. Educate yourself, set strict limits, and never invest more than you can afford to lose. The stock market can be unpredictable, and it's better to be safe than sorry. Don't be a cowboy investor. Taking unnecessary risks can lead to financial ruin. Be smart, be cautious, and always have a plan. Margin trading is not for the faint of heart, and it's essential to approach it with a clear understanding of the potential pitfalls. Section 4, Margin Mechanics, Leverage, and the Dreaded Call. In this section, we will delve into the fascinating yet risky world of margin trading. Understanding leverage and the potential pitfalls of a margin call is crucial for any trader looking to maximize their gains while managing their risks. Let's break down the mechanics of margin trading with a simplified example. Margin trading allows you to borrow money from your broker to purchase more stock than you could with just your own funds. This can amplify your gains, but it also increases your potential losses. Say you want to buy 100 shares of Buy Me Now stock currently trading at $100 per share. This means you are looking at a total investment of $10,000. That's a cool $10,000 investment. However, you might not have the full amount in cash, or you might want to leverage your position to potentially increase your returns. But you're feeling bullish, so you decide to use margin. This means you will borrow part of the money needed to make the purchase from your broker. Your broker requires a 50% margin, meaning you need to put down half the purchase price, or $5,000, while they lend you the other $5,000. This allows you to control a larger position with a smaller amount of your own money. Congratulations, you are now leveraged. This can be an exciting moment for any trader, as it opens up the possibility for greater profits. Now let's say Buy Me Now stock skyrockets to $120 per share. This is where the power of leverage really shines. Your investment is now worth $12,000, a tidy 20% profit. This is a significant gain compared to the 10% you would have made without using margin. Without margin, you would have only made 10%. The leverage has effectively doubled your profit, showcasing its potential to enhance returns. See the power of leverage? It can be a powerful tool in your trading arsenal, but it comes with its own set of risks. But what if Buy Me Now tanks to $80 per share? This is where the risks of margin trading become apparent. Your investment is now worth $8,000, a 20% loss. This is a significant drop, and it can be even more painful because of the leverage. And here comes the dreaded margin call. When the value of your investment falls, your broker will require you to deposit more funds to cover the potential losses. Your broker wants more money to cover potential losses. This can be a stressful situation, especially if you don't have the additional funds readily available. Not so fun anymore, huh? Margin trading can amplify your gains, but it can also magnify your losses. It's essential to understand both the benefits and the risks before diving in. Section 5. A Tale of Two Traders. John and Jane play with fire. Let's meet our fictional traders, John and Jane, to illustrate the real-world impact of margin trading. Margin trading can be a double-edged sword, offering the potential for significant gains but also posing substantial risks. Understanding these risks is crucial for anyone looking to venture into this high-stakes arena. Both have $10,000 to invest and believe Teknova stock, currently at $50, is headed for the moon. They are convinced that this stock is their ticket to financial freedom, and they are eager to capitalize on this opportunity. John, cautious, buys 200 shares with his own money. He prefers to play it safe, relying solely on his available capital. His strategy is to avoid unnecessary risks and ensure that he can weather any market fluctuations. Jane, the daredevil, uses margin to buy 400 shares, doubling her exposure. She believes that leveraging her position will maximize her returns, and she is willing to take on the additional risk for the chance of higher rewards. Fast forward a month, Teknova soars to $75. The stock's performance exceeds their expectations, and both traders are thrilled with their initial success. John's portfolio is worth $15,000, a 50% gain. His cautious approach has paid off, and he is pleased with his substantial profit. Jane, with her leveraged position, enjoys a cool $10,000 profit, doubling her money. Her bold strategy has yielded impressive results, and she feels vindicated in her decision to use margin. Thrilled, Jane considers herself a financial wizard. She is confident in her ability to navigate the market and believes that her success will continue. But wait, the market is a fickle beast. It can change direction without warning, and even the most confident traders can find themselves caught off guard. Teknova gets hit with bad news and plummets to $25. The sudden drop is a harsh reminder of the market's unpredictability and the inherent risks of trading. John's portfolio is down to $5,000, a painful but bearable 50% loss. His cautious approach has mitigated the damage, but the loss is still significant. Jane, however, faces a financial bloodbath. Her leveraged position has magnified her losses, and she is now in a precarious situation. Her portfolio is decimated, worth only $10,000, a 100% loss. The devastating impact of margin trading has become all too real for her. She receives a heart-stopping margin call, forcing her to deposit more money or face the music. The pressure is immense, and she must act quickly to avoid further financial ruin. This story, my friends, highlights the dramatic ups and downs of margin trading. It serves as a cautionary tale for those who may be tempted by the allure of quick profits without fully understanding the potential consequences. It's a wild ride, and not everyone has the stomach for it. The key takeaway is to be aware of the risks and to approach margin trading with caution and a well-thought-out strategy. Section 6. The bottom line. Tread carefully in the margin zone. Margin trading, like a bucking bronco, is not for everyone. It's a high-risk, high-reward game, best left to experienced investors with nerves of steel. The potential for amplified gains is undoubtedly enticing, but remember, losses are magnified too. Before even considering margin trading, ask yourself these crucial questions. Do I fully understand the risks involved? Can I handle the potential for significant losses? Am I prepared to meet a margin call? If you answered no to any of these questions, steer clear of margin trading. It's like playing with fire and you might get burned. Section 7. Now it's your turn. Share your margin trading tales. So there you have it, folks. The ins and outs of margin trading laid bare for you. It's a powerful tool, but one that demands respect and caution. Now I want to hear from you. Have you dabbled in the world of margin trading? Share your experiences, both good and bad, in the comments below. Let's learn from each other's wins and, more importantly, our mistakes. And don't forget to tune in to Mad Money tonight, where we'll be discussing more exciting investment strategies. Stay tuned for more.